2025 investor meeting for January. Let's go around the room for introductions.
Stephanie Jenberg, representing Commissioner Tisch.
Nicole Jambrisi, Police Pension Fund, present by invitation.
Endorsement designee for Control, Brad Lander, president. Steve Meyer, CEO from BAM, and invited participant.
Kevin Lee for Mayor Adams.
Nadia Fazulina for Commissioner Hibla.
Arthur Rega, PBA.
Al Cerno, PBA.
David Morris, PBA, present by invitation.
Rob Appling, Wilshire by invitation.
Anthony Borelli, SBA. Jeffrey Ward, DEA. Lou Chuckle, LBA. Robert Hackmeister, CEA.
Bob Senskis, Pension Fund, present by invitation. Also present.
Andy Vincent Miller, Police Pension Fund, present by invitation.
Ronald LaRosa, Comptroller's Office, present by invitation. Ricky DeCosta, Comptroller's Office, present by invitation.
John Mercerberg, Controller's Office, present by invitation.
Robert Tang, Controller's Office, present by invitation.
Kevin Holland, Police Pension Fund, present by invitation.
Neil Messing, Comptroller's Office, present by invitation.
Katarina Schumann, Controller's Office, present by invitation.
Ms. Fielding, Comptroller, present by invitation.
Dan Hodge, Comptroller's Office, present by invitation.
Leon Dunklin, Controller's Office, present by invitation.
Timothy Gifford, Police Pension Fund, present by invitation.
Milton Jumalo, Controller's Office, present by invitation.
All right, thank you. And with that, John, we hand it over to you.
Great. So I'm just going to welcome everybody to what I hope will be a prosperous 2025 for this board and for the members and beneficiaries. So with that, I'm going to turn it over to Steve Meyer to walk us through the quarterly presentation. And then I just want to note Dan Haas is here to talk about any risk to the portfolio that will be covered in the presentation as well. So, great.
Steve, it's all yours.
Thank you, John. Good morning, trustees. Happy New Year to everyone. I'm going to try to be crisp and light this morning, and give you a quarterly update in terms of what's going on in the markets, what's going on in the economy, and how your performance looks. The executive summary is that the economy is quite resilient. Markets have held up very well, particularly equities, and the performance has been strong. So that is a backdrop. Maybe the first slide, Kate. Just a look at one of the recent headlines around Trump's reelection and concerns about inflation. Obviously, inflation expectations are somewhat elevated these days, given concerns about the unpredictability around tariffs, tax cuts, and immigration policy, and the impact on inflation. All three of those would be inflationary if they're put into full effect. On the next slide, just a quick look at CPI and where it is. On the far right-hand side, you can see this is a 10-year look at inflation. CPI is in white up top. You can see it peaked at 9.1% in 2022. It's come down nicely, but pretty much stalled out on the right-hand side, rounding up to 2.8%. So it's above the Fed's 2% target. And in yellow, you can see core PCE, one of the Fed's preferred measures. Same thing, a little over 2.8% and somewhat sticky. On the next slide, look at inflation progress here and abroad. The U.S. in red, you can see again, stalled down on the right at a little over 2.5%, closer to 3%. Likewise, you see UK and Eurozone inflation coming down nicely. It's interesting to note that the last three prints on inflation for all three have been higher than the prior print. So again, inflation's been a little bit sticky. On the next slide, a quick look at employment. Unemployment in the U.S. has actually been quite low historically. It's been trending up a little bit at 4.2% today, but again, still quite strong relative to where we are in the economic cycle. On the next slide, just a look at where we are, a chart, and you can see it white at the bottom through November. Actually, we get December's unemployment rate this Friday, the 10th. But again, unemployment of 4.2% is certainly not something that would concern the Fed. And the labor force participation rate in yellow, you can still see it's below where it was pre-pandemic. That may have more to do with demographic shifts and a retiring aging population. On the next slide, quick look at a couple recent headlines. And obviously there's some questions around, as I suggested, about tariffs and the impact on inflation. Also some comments that came out of Mexico. We've seen similar comments out of some of the other countries that may be impacted by U.S. imposed tariffs. And the impact of tariffs really depends on our trading partners' responses and how much of those tariffs will actually be absorbed by companies in terms of reducing their profit margin. So again, a lot of uncertainty there. On the next slide, a look at gross domestic product growth, here and abroad. The U.S. obviously is in red. You can see, coming in just under 3%. Actually, the third quarter revised, GDP number actually was revised up from 2.8% to 3%. Trend is closer to 2%, so the economy has actually been quite strong and quite resilient, particularly given the fact that you had significant interest rate hikes that began in March of 2022. The other countries worth noting here, I guess, if you look at China as an outlier, they're seeing 4.6% GDP growth, and it seems like a great outcome, not relative to expectations. The expectations are for those that growth rate to be closer to 5%. So on all fronts, growth has been a little bit sluggish, again, with the notable exception of the U.S.
Could I interrupt and ask a question?
Sure.
about the last slide?
Absolutely.
So you mentioned that some tariffs, some companies will absorb the cost. Does that really happen?
It has in the past, when they were first imposed in Trump 1.0, a lot of the tariff expense was absorbed by the companies. It depends on their willingness and ability, how much of the profit margins are. So those are some of the unknowns of the unpredictability of the size of the tariff, and then the response of the country and the response of the company. So again, an added element of unpredictability that's concerning the markets right now.
Thank you.
Sure. On the next slide, just a look at where we are in terms of interest rates. And it's actually very interesting today in particular. We've had 100 basis points of Fed official interest rate cuts on the short end of the curve, coming in at just 4.5% today, in terms of the Fed funds target. Actually, since September, 10-year U.S. Treasury yields have moved up, as of today, 100 basis points. You have that interesting dynamic where short rates are going down significantly and starting to stall out a little bit, but long-term rates have backed up quite seriously. Future Fed cuts are going to be dependent upon the data and inflation in particular. But right now, the Fed is expecting to see just 2 25 basis point rate increases by the end of 2025. Again, so just 50 basis points more of interest rate cuts that are priced in. On the next slide, just to look at where we are from a central bank perspective, you can see the Fed up top in white. Again, the official target rate right now is 4.5%. The Bank of England has also been reducing rates and is expected to cut again this month at 4.75. The ECB level is at 3%. And the one outlier on the bottom in purple is Japan. They're actually raising rates, but again, from very, very low and negative 10 basis point rates in 2020. That persisted for about 8 years, have now started to reverse some of that out, but they're still relatively low relative to the rest of the world. On the next slide, even though lower official rate, we have lower official rates, we've seen much higher and more volatile long-term yields, as I mentioned. That's an expansion of something that's called the term premia, and that's the amount of income you receive for investing further out in the maturity spectrum. So 10-year U.S. Treasuries, that term premium is widened out significantly to close to 30 basis points. And that is something that the Fed needs to watch, and more importantly, the U.S. Treasury needs to watch in terms of issuance and the cost of our debt. Let's skip the next slide, Kate, and go to the Treasury yield history. And you can see here in green, you have the 10-year U.S. Treasuries at the time of the snapshot of 457 and 463 today. Again, in September, they were as low as 363. So again, quite a backup in yields. As yields move higher, bond prices actually move down. You'll see some of that in your performance numbers. And 2-year Treasury yields, which are more sensitive to changes in Fed official policy, at just 4.25, actually 4.28 today. So again, some interesting dynamics in terms of fixed income. If you have a chance, I actually did a 2024 review and a 25-year outlook, 2025 outlook, and you can, and in that writing, I actually described some of the dynamics that are impacting those. On the next slide, slide 14, again, this is that expansion of the term premium, and you can see that the 2s10 spread, what you get above a 2-year Treasury yield relative to investing another 8 years out into 10 years is about 32 basis points. On the next slide, also on your fixed income portfolio, credit spreads are actually relatively narrow. And you can see the credit spreads in orange for high yield credit spread is just a fancy way of saying the additional return, the 2.82 percentage points that you actually receive by investing in a high yield corporate bond relative to a U.S. Treasury bond of the same maturity. So high yield spreads are relatively tight inside of 300 basis points at 382. It's up a little from the recent lows. And in the investment grade space, we're investing in investment grade quality bonds. There's still a pickup of 80 basis points above comparable U.S. Treasuries, but again, that's relatively tight as well. It's tight for a few reasons, based on the fact that we have a solid U.S. economy. There are attractive total yields because the base rates, the Treasury rates are higher. Even though the spreads have narrowed, the yields are still attractive to many investors, and relatively modest to low default rates, which are both powering the performance of both investment grade and high yield. On the next slide, a quick look at some recent headlines. The Trump trade, which when Trump was reelected, I should say, as president in November, we saw a rally in risk assets quite significantly, moving the prices of many assets, including equities, higher. Bitcoin was one of the beneficiaries there as well, to name just a couple. A little bit more volatility around treasuries, but the market did rally on the recent news that President-elect Trump was looking to appoint Scott Bessent as the new U.S. Treasury Secretary. He is someone that Neil tells me actually presented. Yeah, I don't know if I mispronounced that again, Neil.
Yeah,
Bessent. But he's actually presented to the police. He was actually one of your high yield managers at Key Square for a number of years. So these are folks that have actually been in this room and presented to you in the past. Again, he's considered to be a high quality and very competent individual. So I think the market is at least relieved to see that appointment coming down the pike as well. And lastly, on the bottom, it talks about private equity, and the lazy days are over, if there ever were lazy days. And that just means that with higher rates, that you can't simply rely on adding leverage at zero cost, so very, very low cost, to generate returns. The expectation is for returns to be generated or value creation through more operational efficiencies and strategic initiatives that your private equity managers. And as they come through, they'll be talking more about that over time. On the next slide, a look at public market benchmarks for the calendar year through September 30th. And you can see this is a pretty good story. In 1 year space, I mean, look at that. U.S. equities is measured by the Russell 3000, measuring from September to September of 2020, September 23 to September 24, is up fully 35%. If you look to the far right, and you can see in gray, where it's expected, this is the average expected return for U.S. equities, averaged across the 5 general consultants for the 5 different plans. And I think you're probably pretty close to this as well, Rob, in terms of the expectation. But 6.7% is forecasted to be the average return over the next 10 years. That 35% that we saw again September through September 2024 is an anomaly. It is not to be expected. So it's interesting. At the end of this year, we had 2 back-to-back years where the S&P 500 delivered close to 25% net returns, or total returns, I should say, including dividend payments, which is, they haven't seen that since the late 1990s. And again, that's not to be expected going forward. And we do think that you'll see much lower returns in public equities over the coming years. Other than that, we still see a little bit of pain in governments. Sorry, Kate, went back, staying up. Thank you. At negative 4.6% in 3 years. Again, we went from a position where during the pandemic you had U.S. Treasury 10-year yields were as low as 67 basis points at one point, less than 1% return to invest for 10 years. Those levels again right now are 4.63%, so almost 400 basis points or 4 percentage point higher. And you can see that as yields move up, bond prices move down. It's been a tough ride to get here, but your fixed income portfolio now is generating more income at 4+%, notwithstanding some headwinds around capital gains or losses. And that's a better position to be as a long-term investor. On the next slide, just a look at the level of disruption on the far right-hand side. Again, you can see the equity returns on the left. The bigger story here is the downdraft that we saw in 2022, 2023, and even into 2024 in terms of the losses associated with your fixed income holdings. Again, painful to get there, but you're at a higher rate where you get more carry and more income off that portfolio. On the next slide, just a headline, Trump is back. Whether you like him or don't like him or voted for him or didn't vote for him, he is an unconventional politician with an unconventional communication style. There's a lot of uncertainty in terms of the new policies that will be implemented and actually what will actually be achieved relative to the rhetoric. So a lot of uncertainty. I think this will result in an increased level of volatility this year for the coming months following his inauguration. So just interesting time to be an investor or participant in the
Does
market.
that impact how we invest, or what you'll be recommending, or how do you see that impacting us?
That's a wonderful question. That's the right question to ask. And, you know, I think the benefit is you have a good strategic asset allocation plan that we worked on with Wilshire. You're highly diversified across strategies and asset classes. So whereas some asset classes may do better than others, you're well positioned. Your plan is too big to be tactical. You can't be trading in and out of these markets. So you want to have a long-term view. I think you're well positioned. So I can't promise you'll see 10% return every fiscal year end like you did in 2024. But again, I think you're well positioned. We've had some laggards in the portfolio. Real estate's underperformed as we move to higher rates, and there's some questions about office space. Fixed income's been challenged, but again, moving to higher yields means more income or more carry that you get every year, which is a good thing. So again, real estate and fixed income have been a little bit challenged and underperformed. They'll probably do better as rates stabilize at somewhere close to 4.5 to 5% 10-year Treasury yield.
And do you think that will happen?
I do. I think that there'll be a return of animal spirits. There's an expectation that President-elect Trump is more pro-business, which means less red tape, less regulation, lower taxes, potentially less of a regulatory scrutiny around combinations or mergers and acquisitions, and that will serve to increase the level of activity, increase the level of exits you have in your private equity portfolio. So I think private equity was going to do better. I think a lot of the good news has already been achieved in public equity, and I know John will comment on his views early, in a little bit in the annual plan. Again, we're not tactical, we're strategic, and I think as a result of that, you're well positioned. I don't know, Rob, do you have anything you want to add to that, just in terms of?
No, I think you said it well. I don't think we would make any changes based upon a new Trump administration. I think a lot of his, the rhetoric around his policies with the tariffs are that there could be inflationary in nature. We'll see if that's the case, but you also have a lot of inflation protection assets in your portfolio currently that should do well. You know, a lot of times with inflation, you think it's going to erode your purchasing power, but oftentimes those prices are passed along to the consumer vis-a-vis, public equity. Private equity, we expect to outperform inflation. So there's a lot of growth assets in your portfolio and a lot of assets that would do well if inflation does pop up. So
infrastructure as well.
Exactly.
As volatility picks up, you actually increase your allocation to hedge funds, which should actually do quite well in a more volatile environment as well. So again, you're well diversified. Private equity, for example, typically, Anash and his team have done a great job of returns. The expectation is between 12 and 15% net. Those returns this year are about 5%. So again, a little bit of a pullback and lower level of performance. Again, but with the pickup in mergers, we think that will increase. So infrastructure should do well. I think you'll see a bottoming on it in office space should start to improve, which will empower the returns in real estate, which were negative this year. Hedge funds, again, with a more interesting dynamic and more volatility, should do well. Fixed income with those higher, that painful move over the last few years to higher rates should also benefit the portfolio.
Steve, since inflation is not transitory, and we're using the word sticky means it's not going down.
Yeah.
It seems as if when you go to the supermarket, everything gets either priced in at that number or even going up. It's not going down.
Yeah.
How do you see if oil becomes cheaper? Gas is $3 a gallon. If it goes down to $2 a gallon, do you see that affecting inflation because now transportation is cheaper to get the product there? Producing it may be cheaper. Do you see, because right now it's not transitory inflation. You go to the supermarket, you see it. how do we bring these prices down?
That's a great question. It's very insightful as well. You're absolutely right. We've gotten this transfer, we've gotten to a level where rates are higher. They're not gonna see deflation where they're gonna start to move down again, but the pace of inflation will come down. That's called disinflation. Your question around oil in particular, oil's in everything. It does impact transportation, it's in a lot of the products. And lower levels of oil prices actually, I think, would be positive in terms of reducing inflation, which would be good for the economy. So that is one of the aspects of, I think, Bessent, U.S. Treasury Secretary Bessent is looking to increase the level of production of oil. He's looking to reduce the amount of debt we issue to just the deficit to 3% versus 5 or 6% of our budgets now. So there's a number of things that would impact that. The concern, if you're old enough to remember, I remember 1973, 74. That was when Tuna Helper first showed up in the Meyer household in terms of it was the first oil shock, and I was 13 or 14 at the time, and my mom tried to pass it off as better than steak, which it wasn't. But you're right. That was an example of the OPEC issues, the two oil price shocks. There are concerns right now about a double dip in inflation. So if you look at, there's a chart in here that looks at where we were in the 1970s. You have the spike in 73, 74, and then another spike in 78, 79. Those are oil related, but there is concern about the fact that inflation's sticky. It's not really moving down, and things seem to be still more expensive. Bunch of questions, but you're right. The lower oil prices or more oil production, low oil prices would reduce inflation, where some of the other elements may boost inflation a little bit. Okay, if we can move to slide 21, please. Just interesting. You can see on the far left-hand side, interest rates started to hike pretty aggressively. The Fed started hiking rates in March of 2022. But look how strong the economy has been. Even though we had rising interest rates, there's really no question of these long and variable lags. U.S. real GDP growth has been quite significant. We haven't had any negative growth. We didn't have a recession. We're, again, if you look to the far right, we're not at 2.8%. It's revised up to 3% for the end of the third quarter. That's actually quite resilient. And again, I think that's helped power the performance of your portfolios, particularly equities. That's a good outcome. Similarly, on the next slide, same slide, but looking at consumer spending. Consumer spending held up really well. And I think a lot of this has to do with coming off of the COVID. There's a lot of pent-up demand for services and experiences. And people have gone out and spent money. They actually had built up a little bit of a cash reserve during COVID, which helped, again, provide the financing for this performance. So it's an interesting dynamic right now. On the next slide, again, this is that little bit confusing chart, but if you look in the dark blue, that's the 1970s. And 74, you see the first spike, and then 79, 80, you see the next spike in terms of oil price shocks. And where we are in green today is we see an inflation spike and CPI up to 9.1% at its peak. It's come down nicely. It's stabilizing. The concern is there are other elements or things that could happen in the economy or through policy that'll cause inflation to reaccelerate. And I don't think you'll see the same because, again, that was an interesting, kind of a unique period of time, but certainly bears watching.
Steve, if people are spending more, are they spending their own money or on credit? Because is there a bubble waiting to burst on these credit card debt that's through the roof?
We actually have, I think there's another chart in here that will answer that, but actually the U.S. consumer balance sheet is quite strong. That we're still in a much stronger position. We have lower level of debt than we did pre-pandemic, but it depends on where you sit. So if you're in the top 20 or 25% of our earners in the United States, you've used any cash reserve that you built up, and a lot of that's credit card related. We're not at extreme levels to say where we were in the 2008 period when the global financial crisis hit. Again, another great question though. It bears watching.
Producers here be yelling at me. If I got two, you got one.
That's the hardest you've worked all day.
I'm done. I'm gonna go home. I'm done asking questions. That was reason for you in my life.
Next slide, Kate. A look at leveraged loans in terms of no one really cares about leveraged loans unless you have one, but I think on the far right-hand side, you can see that the level of defaults are moving down. So credit quality has held up quite well, and that's been good for the economy as well. On the next slide, just a look at immigration. and one of the advantages that we have as the United States is we attract a lot of talent from abroad. I think there was an article that came out just yesterday that said that net immigration to the United States in 2024 was 2 million people. And I don't necessarily condone illegal immigration, but immigration and bringing the best and the brightest to the United States, I think is a great thing. When you look across, our office, you look across the Bureau of Estimates, we have people from all over the world that are really quite talented, making a contribution. The benefit of having resurplus or resourced employment force is that it keeps wages down and keeps inflation down. And that's why there's concerns if there's deportation or less of a liberal, I shouldn't say the word liberal, less of a constructive immigration policy that may reduce the amount of immigrants that come into the country legally. That could be negative in terms of the number of people who can fill jobs, and could be inflationary from a wage standpoint.
Lou, you wanna go 3 for 3?
I'll leave that one alone.
Yeah.
I'll leave that one alone.
Yeah, I'm dancing around that one as well.
Yeah, I'm gonna let you leave it on the dance floor.
On the next
So
slide.
you think deporting illegal aliens is gonna cause inflation and make, did I see that right?
Yeah, so I think that's the expectation, is you see a massive deportation, and I'm not saying criminals, because that's a different
But
issue.
is there gonna be a mass deportation?
I don't know. I mean,
It doesn't look, like, I haven't heard that.
I think that's really hard to achieve.
I also think the word mass is something that has to be
Yeah.
codified. What does the word mass
Yeah,
mean?
what does the word mass mean? I mean, you got illegal, these migrants are burning people on the subways. I mean, these people,
Yeah, there were some bad elements.
I mean, these bad elements, they gotta go. I mean, is that gonna drive
I don't
inflation?
think so. I think the bad elements are people with criminal records, that have criminal records and committed crimes here in their country. That's a different element. There are a lot of people that come to the United States just for a better way of life.
Of course, yeah, I know, but we all have.
Yeah.
But at the end of the day, I don't think deporting criminals out of the country is gonna drive inflation.
No, I don't think that mass deportation, that's not what that means. It means anyone that's here illegally, versus those that are here committing crimes, that are here illegally or illegally for that matter.
Look, I think that we're in a situation where there's been a lot of statements made by the incoming president-elect. And in a couple of weeks' time, we'll see what actual policies he puts into place and what the reaction of the federal government is. And I think it's premature for us to speculate on what we think is gonna happen as far as whether or not, they'll deport people that are here, if they'll be able to find work here, if they'll be issuing work papers, whatever the case may be. I think it's too premature for us to try to figure out at this table what we think the federal government's going to wind up doing in 3 weeks' time. So I think we should, this is an important question, but I think we'd be better off tackling it in a month's time when we can see what's it, 6 months' time is when we're really going to be able to see what happens, but to see how that actually impacts us. And as we've heard from Steve already, we're a slow-moving behemoth of a plan. So we can't really be reactionary, but we need to slowly move this tanker in the direction it needs to go in. We'll see what policies get enacted and go from there.
With that, maybe next slide, Kate. Just to look at corporate earnings relative to gross domestic product. They're actually near record all-time highs. So the economy's done well, the consumer's been resilient, corporations are actually generating significant earnings. And again, that has a lot to do with what's happened in your portfolio the last couple of years and expectations for the future. On the next slide, just a quick look at household balance sheets. Actually, this answers your question. If you look on the bottom in green, that's actually the level of indebtedness of the U.S. consumer. And you can see that level of debt has come down. It peaked right before the global financial crisis, came down significantly. It was a little choppy around the global financial crisis, but it's still relatively low. If you look at it relative to the other dollar block countries, Canada and Australia, it's in a much better shape. So we can continue to see that the consumer could be resilient and continue to spend, albeit potentially with some level of debt. On the next slide, we talked about fixed income earlier. We talked about credit spreads. Again, a fancy way of saying just what's the return you achieve above a comparable duration or maturity, US Treasury. And you can see in red, it says latest, it's on the left-hand side of the chart. It actually shows two things. First of all, credit spreads are less than 100 basis points in the bottom, and that's relatively tight. But importantly, the absolute level of yield is still almost 6% or 5.5%. So again, that's why you've seen flows into the asset class, notwithstanding the fact that credit spreads are tight.
If you're looking at that, that would be
Looks like Long Island.
Belfast. I actually think it's more, it looks like it's Ireland, Northern Ireland, and Europe, and it would be where Belfast is, it looks like, on that little, where it says latest.
Well, I'm not traveled like you, I'm saying, well traveled.
John, what do you know about Ireland?
You know, I know what a map looks like.
Those are interesting observations, John. Thank you for that.
Value add.
Moving on to the next slide, just a look at money market holdings. You can see there's about $6.5 trillion still sitting in money market funds. And again, part of that has to do with the fact that the Fed funds rate is 4.5%, which is still relatively attractive. So the expectation is you see rates continue to move lower. Again, the Fed, through the summary of economic projections, have only forecast 2 more 25 basis point rate cuts by the end of this year, 2025. But there's still a lot of money in the short end of the curve that can be deployed to longer bonds or equities or spent. So we're in pretty good shape that way. On the next slide, and I don't mean to beat a dead horse, but just in terms of where we are in terms of fiscal policy, deficit spending, I actually believe that we should keep a close eye on where we are on US Treasury yields and that fancy term premia, how much you get paid for investing further in a longer maturity. But there's a couple things in the works. So the things that I would focus on, US sovereign downgrade. Fitch and Standard & Poor's actually downgraded US Treasury debt from AAA to AA plus about over a decade ago, 2011, 2013. Moody's actually put the US debt on credit watch negative in November of 2023. And the expectation is, given the concerns around our deficit spending, that they'll eventually downgrade us to AA plus as well. So something to watch. Treasury auctions. The Treasury auctions get larger and larger as we continue to recycle our debt. We have a lot of debt right now that's in Treasury bills. Again, that helps with the $6.5 trillion in money market funds, but there's a lot of turnover in debt. So that bears watching. The performance of the Treasury auctions, are they what's called fact tails, where if it's expected to clear 4.5%, it clears at 4.60. That's something that bears watching. Term premia, again, that fancy term that basically assumes that I don't care if I invest in overnight rates or 10-year rates, as long as they're comparable long-term. So that you actually can't observe term premia, but you can calculate it. And as it widens out, it makes our debt more expensive. It actually also provides the portfolio with more income or carry, fancy way of saying it. And the last point I'd say here is focus on what happens with the US dollar. US dollar is incredibly strong right now. Each dollar buys 157 yen. That's close to a record. Right now, the euro buys $1.03, and that's expected to go each euro by just $1. The pound sterling, the UK is actually depreciated in value from around buying $1.30 now buying $1.23. Again, the interest rate differentials, the flows into US dollars actually have benefited the dollar. And again, the resiliency of the economy. I'd say the things that I'm concerned about are gradual higher long-term interest rates. You can see that as the last point. More likely is a gradually higher long-term interest rates and a steepening of the yield curve. A steeper yield curve is not a bad thing necessarily if you're investing out in the curve, but it may have an impact on the amount of interest expense associated with rolling our debt and our deficit spending. On the next slide, again, not to beat a dead horse to death here, but you can see our level of deficit spending on the far right-hand side in black, where that line is about 100% of gross domestic product. It's $27, $28 trillion economy. We have $27 or $28 trillion worth of treasury outstanding. The last time it was this high was during World War II, and you can see that first spike in terms of just at that point, you spent money regardless of any fiscal discipline because you were fighting a war. And the concern is on the far right-hand side, the estimate from the government itself is that the deficit spending at its current rate will increase GDP relative, debt relative to GDP to 200% in the next 20 years. So something that we need to get our head around and our arms around in terms of the impact on the economy. On the next slide, again, a little further on this point, you can see on the far right-hand side in blue, those are forecasts. Again, these are the Office of Management and Budget. They're actually forecasting almost a 5% deficit as far as the eye can see. The interesting thing is the incoming U.S. Treasury Secretary has confirmed is looking to help to put in things in place to help reduce that by expanding growth and being more disciplined in terms of the level of deficits to around 3%. So that would be certainly an improvement, but still a lot of debt out there. On the next slide, we have $9 trillion worth of debt in green that turns over every year. That's about 1/3 of the outstanding, about 27 trillion in size. So again, watch the auctions to see how that performs. And last point here on the next slide, in green, you can see that the outstandings on the far right-hand side, a lot of those are in bills, green or U.S. Treasury bills, again, which turn over weekly. Again, a lot of demand for those associated with the dramatic amount of money that's right now in money market funds, but that could change. And maybe one more last point on the next slide, on the far right-hand side, you can see the term premia for 10-year U.S. Treasuries has gone from being negative to being positive about 25 basis points. Again, that just means that it's more expensive to issue. It's better to invest in longer-term debt now. And you can see that in terms of the base rates in your fixed income portfolio. That's the last slide on what's going on in the economy. Now, just a quick look at your fund's performance. On the first slide, Kate, one more. You can see your performance in the 1-year space in the middle of the page. The police's total pension plan for the year September 23 through September 24, including private assets, you've generated a return of 17.5%. You have a 7% target. Again, that's through the fiscal year end. That's not sustainable. It's actually been a very, very strong performance in public markets in particular. We hope to see some catch up in private markets, but again, a great outcome. Anytime you see a slide like this with your performance and it's all green, and very much so, is a good outcome. I think we should focus more on the 10-year returns on the far right-hand side. And here you can see that over the last 10 years, on average, your plan has returned 7.9%. Again, that's off of that 7% target, so a good outcome. Evidence of that on the next page. I love this slide that Dan put together, Van Haas put together. This actually looks at if you were earning 7% on your portfolio consistently over the last 10 years, where you'd be. The orange line is at 7%, and the blue line is actually above that, which means you've generated a higher level of return, and you can have more assets as a result of that. So a very good outcome so far. On the next slide, I'll look at police's net public market returns by asset class. Again, anytime you see a slide with your performance and it's all green, it's really quite positive. In the 1-year space, again, September to September, 33% return on your U.S. equity positions alone. But again, more importantly, if we look further out on the right, 12% returns in public U.S. equities, 7.1% in developed market ex-U.S., just 4.1% in emerging market equities, and then below that. The pain point is, again, in fixed income, generating a negative return of 2.4% in the 3-year space. And again, that's the backup in yields we saw in 2022 and 2023. And again, moving to a higher rate should help performance over time. On the next slide, I'll look at your excess returns relative to your benchmarks. Here, unfortunately, there's a little bit more red, and the performance of the index has been very challenging for any manager, any active manager. And you can see that's evidenced through the negative excess returns that we've generated through active management further out the curve over time. And again, I know that John and Robert are working with Ed Berman in terms of strategies to reduce fees and improve performance relative to benchmarks. And I know Robert and John will talk about their expectations for 2025 and the plan in a little bit. On the next slide, just a different way of looking at holdings in your pie chart. You can see about $39 billion in public assets under management. On the right-hand side, I understand that some people suggested this report's a little confusing. It's just a different way of looking at the different time periods: 3 months, 1 year, 3 year, 5 year, and 10 year in purple. And what you want to see is the darker line above the lighter line. The darker line is your performance, and the lighter line is actually relative to the market. So cash has outperformed, emerging markets has outperformed, and world ex-US has outperformed its benchmark over the last 10 years in positive returns. Again, look at core fixed income in the 3 year space, which is in green. Negative returns, again, that moved from a US Treasury 10-year yield during the pandemic of 67 basis points. So again, something that's 400 basis points above that. Next slide, quick look at public market fees. Your fees for the quarter, the third quarter, were about $13 million on average, and on an annual basis, they're closer to $52 million. On the far right-hand side of the bottom, you're all in, for all strategies combined, you're paying average 14 basis points in fees. We're actively looking at how we can reduce that, how we can put ourselves in a better negotiating position with your managers. I know that Ed has worked with John and Robert very closely, and Ed's team, in terms of developing quantitative analysis that will help us negotiate fees down. And we're happy to go through that at any time. But again, the fees are important because those are the things you have typically, particularly in public markets, have some degree of certainty around those. And we should be dogged in terms of negotiating those fees lower consistently over time. On the next slide, a look at your net private market returns by asset class. Again, great slide. It's almost all green with the exception of real estate, which still has some challenges associated with higher base rates, higher interest rates, and some struggling in your office allocation, which is under market relative to it's underweight relative to the index. But again, your net returns are generally positive across the curve. If you look at it in 10 years, you can see hedge funds at 5%, and there's other benefits associated with hedge funds in terms of the dampening of volatility. 12.2% private equity, again, versus say a return this year of just 4.5% through September. Infrastructure has been steady Eddie. You look at 10% 1 year, 11% 3 years, 10.9% 5 years, 11.6% 10 years, and since its inception, 11.6%. A great outcome. And alternative credit, if you can look, you see it to the far right-hand side, it was lower level because floating interest rates, the Fed funds rate was much lower. And now that it's several hundred basis points above that, you can see alternative credits actually produced almost a 12% return, again, September to September, and those marks are accurate, so a good outcome there. On the next slide, relative to excess return, a little bit more of a mixed bag. Again, let's pick on private equity. This is not a reflection that Anash and his team have done a poor job by any stretch. It's just that the Russell 3000 has been just off the charts in terms of performance. The Russell 3000 for full year 2023 was up 25%, and through the end of September 2024 was up 28%, plus a 300 basis point premium for illiquidity on top of that. And that's hard for the portfolios to match that. And again, that's a reason for the negative performance that extends outward, and I don't expect that to persist over the long term. Same slide here, in the next slide, just to look at assets under management across your alternative assets. And I have to say alternative versus private, because hedge funds oftentimes will have strategies that involve clearly public market securities. But if you look on the right-hand side, again, the darker colors being more positive, and in orange here, just to spice things up, you've had outperformance in several asset classes, and particularly look at infrastructure. It's outperformed its benchmark consistently by a wide margin in 1, 3, 5, and 10 years. One final slide, the next slide, just to look at where you are in private assets across private equity, real estate, infrastructure, and alternative credit. And this is actually the investments that you have in the ground right now are about $13.3 billion. You actually have another 6.8 billion that you've approved that has not yet been called for total exposure, not necessarily in your portfolio today, but about $20 billion. It's more reflective of the unfunded commitments that you've already made across these different asset classes. And with that, I'll open up the questions. Mr. Arney?
All right, hearing none.
No
Wait,
questions.
I do have a question. So for the $7 billion that's unfunded or whatever, when do you think that will be put into use?
It varies. It'll be called over time. And remember also that you have a mature portfolio in many respects, so that you'll have distributions and exits. We have money coming in and money going out, but that'll be called over the course of several years. So it's not as though you look at this and say, well, my gosh, we're supposed to have a $13 billion allocation. We're really at 20, we're way over our weight. That's not necessarily the case because you'll have distributions. And these are dynamic portfolios that will be drawn down over time, but also pay off over the same time horizon.
Do we lose money when that money is just sitting someplace?
It's not just sitting somewhere, so it's invested in proxies. So the proxy for, say, private equity is invested in the Russell 3000 index. And John Merceberg actually takes care of that as part of the public equity allocation. So it's not as if it's sitting in money market funds earning 4 or 4.5%. It's invested in equities, and it's actually outperformed public equities has significantly outperformed private equity in the last 2 years. So it's been an advantage.
I mean, you could theoretically lose money too.
Yeah, absolutely, John, good point, yep. And alternative credit, as the other side, is primarily invested as proxy and high yield.
So that is Steve, a very good question occurred to me.
I'll be the judge of that.
Does that factor into the basket? The money, only the money that's dispersed is considered part of the basket, correct? Not the money that's
That's right,
on the
John.
sideline?
Yep, that's right.
Makes sense.
I'd like to say it was a good question.
All right.
Thank you, Steve.
All right, so,
We have a quick update from Dan Haas, who is actually the interim chief risk officer as well as head of reporting. So we're trying to combine those functions so we have better analytics associated with what we put in front of trustees.
Dan, come to the table.
Dan, you're allowed, here you're allowed to.
Dan, he used 30 minutes of your time, so you're left with 30 seconds.
Right, gotta be quick.
To walk us through the risk.
Well, thanks for having me, everybody. Appreciate it. And as John and Steve mentioned, I'm filling in as chief risk officer for now. You know, we go through a hiring process, and I intend to throw my hat in the ring this time around. Hopefully, we'll get it, but at least for now, you got me. I think Kate, you mind throwing the slide forward too? Thanks. That's perfect. I think as we kind of continue the conversation, you know, I've got big shoes to fill, kind of take over from Ed, but I wanted to use a couple of his slides that you've probably seen before, just as a jumping off point for our conversation. And this one I think is really kind of useful. What we're doing is, it's just your total plan summary. This is something we measure for you on a monthly basis. We report to you quarterly. And one of the things I like that Ed did with this was we kind of decomposed your portfolio into a couple of big decisions that we've made along the way, right? As you invest in, you know, in the markets, you obviously have to take some amount of risk. And then you refine that risk by making specific policy allocation decisions. And then you refine that a little bit further by selecting specific managers. And what that table on the top left shows you are the impacts of those decisions. So if we look at that first section, the market portfolio, that's just a 65-35 blend of equities and fixed income. And that implies a certain amount of portfolio characteristics. So for instance, your interest rates duration, that's just a measure of price sensitivity to changes in interest rates. That's 2.1 years or 2.1%, you know, for a given percent change in interest rates. Same thing with credit spreads. It's just price sensitivity to changes in the credit spreads, kind of echoing some of the thoughts that Steve had earlier. That's 1.2. Total risk for that market portfolio is 10.2%, and then it gives you a 0.63 beta to the S&P 500. It's going to give you a sense of how more or less risky this base portfolio is
Can you
to the
just
S&P.
explain that, then? What does beta mean relative to the S&P 500?
So beta is just a measure of this model portfolio's risk to the S&P 500. So to the extent that if you had a beta of 1, you'd have the same risk characteristics, same market risk characteristics as the S&P 500. To
The
the extent that
S&P
we're
500
lower
is
than
up
that,
1%, what would your portfolio do?
I beg your pardon?
If the S&P 500 is up 1%,
You'd expect the portfolio to go up by 1% as well.
there,
Yeah.
but here it's actually would go up
63.
63
Basis
basis points. That's a fancy way of saying, how is it correlated to the S&P 500?
Exactly, right. So what we're saying here is that this market portfolio, that spread of, or that mix of equity and fixed income is less risky than the S&P 500. No earth shattering. It gets a little bit more interesting when we move on to the next two sections. So the policy benchmark, that is reflecting your specific allocations to the strategies in your strategic asset allocation. And you can see that you're a little bit lower overall in equities, but that equity allocation includes your allocation to private equity, includes your allocation to infrastructure, real estate, so on and so forth, hedging line there as well. But overall, you have slightly less equity exposures than you do in that market portfolio. It gives you a slightly different set. You can see that your duration measures go down a little bit. You've got slightly less credit spread and rate sensitivity in this model portfolio. You can see, more importantly, that your total risk is down pretty significantly, 1.4% to 8.8% there. And then you've got a lower overall beta to the S&P. So it's a less risky portfolio. I should mention that, as of Q3, this reflects the strategic asset allocations that we adopted about a year ago, that we've been implementing over time. Talk a little bit more about that later. And I'll just bring your attention to that third section, the portfolio assets in ground.
Sure.
So I can see how our risk level is lower than the market portfolio, but what contributes to our risk being lower than the policy benchmark? It looks like it has similar components. So
Sure.
I don't know if that's a
Yeah. So I'm sorry, you're thinking of the difference between the 10.2%.
Right, so the planned risk level is slightly lower than policy benchmark consistently in that chart.
Oh, yeah.
I'm just curious what contributes to that difference.
So the plan's risk level, that has to do with, there's a couple of things factored into there. It's a specific selection of managers that you have to those policy benchmarks. You have a couple of investment carve-outs. So for instance, you have a global, actually, no, you're fleet, so you don't. But you have a slightly different mix of characteristics in the managers that you've invested in than the benchmarks that you invest in as well. There's another factor in there of targeting places, right? So you have a certain target allocation to private equity, infrastructure, so on and so forth. And to the extent that you are under or over your allocations there, that gets offset to public markets. So we would invest more or less in a U.S. equity manager in the case of private equity. And that's what flies into the mix there a little bit as well. So that's why you see a change between the policy benchmark risk at 8.8% middle there, and the 9.2 that we've observed the portfolio at that you have in ground today.
Gotcha. Thank you.
Sure. And actually, just kind of finishing that thought, you can see that the portfolio beta, is a little bit lower than the policy benchmark, and the active risk, and so the active risk is a new concept here, and again, that's just the variability of returns beyond your benchmark. So we can expect you to perform close to your benchmark, plus or minus 1.9% on an annual basis here. And then I'll just close with the charts on your right. So there's kind of a bit of an interesting narrative here. You can see that if you look at the dotted line on that top right chart, the portfolio risk is, the market portfolio risk is declining slightly over the period. And that's just market dynamics in play there. More importantly, you can see that the benchmark risk and the portfolio risk are both also declining at a more rapid rate. And that's a function of us just investing to the new strategic asset allocation. You de-risked the portfolio last year. So you invested overall in less risky assets. And as we put that into play, you see the risk declining more quickly than the market risk was. The green line there, the policy benchmark, you can see that it's a bit steep, kind of in April, May. Again, that's an arbitrary choice. We had to pick a date to cut your policy benchmark ratios over. That happened in April, and that's why you see that a little bit steeper than the portfolio itself, which was trading a little more smoothly along that curve. And then that bottom one is just your active risk, and again, that's just the variability of excess returns from the benchmark. Pretty tightly bound between 1.9% and 2% or 2.1%. That little blip you see again in March and April of this year. Again, that's us trading to the new portfolio thing. In your portfolios in particular, you have an allocation to 10-year Treasury bucket. It's a little bit higher than the others. And so that's just us trading out of that relative to changing the benchmark on it. So that created a bit of noise, which was transitory, something we expected. It's still fairly tightly bound. Kate, can we move to the next slide? I'm sorry, before we move on, I don't know if you have any additional questions on that. So this one's, again, kind of interesting concept. It just shows, it underlines the fact that, yeah, we have a certain asset allocation, but you're drawing risk from, you're consuming risk a little bit differently than you've actually allocated the assets. Your equity asset classes, particularly your public equity asset classes, consume about 2/3 of the risk. We're a little bit less than 60% of your risk, even though you're about 1/3 of the allocation. You take up some diversification in public fixed income, and again, about 1/3 of your portfolio is aimed at public fixed income, but you're only picking up 10% of the risk there. It's an interesting concept just because it keeps us in mind of where volatility is being picked up, what drives returns, and what can drive, events that we'd like to avoid, like drawdown risk in the portfolio. One of the more important takeaways here, again, is sort of the importance of our periodic rebalancing. We meet on a weekly basis and take a look at your active, we've got a committee within BAM. Wednesday mornings we sit down, we take a look at, your active weights in the portfolio. We talk about market trends, we talk about funding needs, that sort of a thing. And then we try to make sure that, you're pretty in line with the chart on the left. Absent that process, you tend to drift toward the chart on the right, and that would kind of, expose you to more drawdown risk, which is hard to make up, so we really want to avoid. Okay, can we go to the last slide? So this one's actually kind of my favorite, and I want to try to maybe integrate this a little bit more into Steve's narrative. But what we're showing you here is your total risk and return for the third quarter. This is a bit aged because you guys had a pretty crowded agenda last month, but what the bars represent is kind of a 3-month horizon of your total risk or the volatility of the portfolio by each asset classes and actually for the whole system. And then those triangle plots are actually how you performed in that 3-month period. And what I like about it is it tells you in a really kind of intuitive and quick way how well the portfolio performed, relative to what we think is normal, right? The bars are gains and losses that we would expect to see about 2/3 of the time. And then to the extent that, you perform above or below that, you got kind of a 15% chance of outperforming and a 15% chance of underperforming. If you kind of look at those, it gives you a sense of how good the quarter was, and it was a really good quarter. You can see that overall the system was up 4.5%, which is about the top of what we call the normal range, or what we consider to be the normal range. You can see that public fixed income outperformed. It was sort of in that 15% tail positive performance, and that was driven really by rates. The Fed cut 50 basis points in September. I think the market priced in maybe some other cuts. So you saw
362 is 100 basis points.
Yeah, exactly. So the 2 years came in for the quarter. The rates came in 100 basis points, and the 10 years, I think, were down 70. So it drove a lot of performance in that portion of the portfolio, and kind of made up some of the losses that we were observing prior to that. See the same thing playing out in high yield there. It's just a little bit less duration, a little bit more spread back tailwinds for that. That's about all I have for you today. Happy to answer any questions you might have.
Okay, hearing none. All right, I believe that concludes the, public agenda. So I'd like to make a motion to exit public and enter into executive.
Second.
Okay, all in favor, aye. Okay, we are now in executive session, and the cameras be turned off. Any members of the, public or press should exit at this time. Any members of the band team that did not have business before this board should also exit, at this time. So the only remaining staff should be, besides members of the Office of General Counsel, should only be, members of the OCIO and, members representing public equity, public fixed income, hedge funds, and, the, ETI program. So everybody else, I would ask that they, exit at this time. Thanks, everybody. All right. Oh, and, I just want to note, it says that we are still recording, so I would just ask that we stop the recording, please.
Recording stopped.
Recording, so send, all good? Yes.
All right, today the trustees heard from BAM staff and from consultants in regards to performance update and portions of the annual plan. And also, one particular transaction that was brought to the trustees, and the results of that transaction will be disclosed at the proper time.
All right, so with that, that concludes today's agenda. I'll make a motion to adjourn.
Second.
All right.
Sorry, Jeff beat you to it. So, all right, we stand adjourned if they have concerns.